Alright guys, now we're going to get into a little bit more advanced concepts in regards to market structure. So I'm going to start off actually by talking about the Fibonacci. So a Fibonacci is a really good tool to kind of understand where a potential lower high or higher low is going to form. So these are the presets that I have, and I'm going to actually post right after this video. I'm going to put a second video inside of the TradingView platform and show you guys my presets for the fibs, and not only the the presets for it, but also how you can draw fibs in live examples as well. But nonetheless, let's say there's a swing point from here down to here. We draw our fib from that high down to that low, and most of you guys probably already know this. And then we look for a retracement in between the 62, the 70, and the 79. Now, some people use like the 0.88, some people use, different numbers. To me, these are the ones I personally prefer. And I do have extension targets. So extension targets are a really great way for me to kind of determine how far the next lower low is going to be. Typically, you'll hit maybe extension 1, extension 2, and you could possibly, use these as a potential take profit level. Also, these could be potential reversal strategies, but again, I don't really use them for that, but I will cover it in the later videos. Now, when price, let's say from this high down to this low, price retraces into these areas. These are primed areas that we can look for a potential sell scenario. Now, when we couple up like these retracement points with, let's say, some area of resistance, like let's say an area of supply or like a bearish order block, which we will get into in the next couple videos, then you get this really powerful confluence of events where the market has a good chance of reacting here. And also inversely for the bullish side, we'll draw the fib from the swing high. Down from the swing low to the swing high. We look for the market to retrace into these levels, same exact levels, and we can anticipate if the market has a higher low in here, the market will first of all make the higher high above this point and then possibly into extension 1 and extension 2. And now here's a good illustration of this on the bearish side. So let's say the market has a structural high in here down to a structural low. The market has a good retrace back up into here, and you see that how the market drops, and look how it reacts right near the extension 2 level. It does hit the extension 1, and yeah, this is just a really good illustration of how you typically want to see the market trade once we do have a solid retracement into these levels. Now, I'm going to go ahead and talk to you guys about market structure shifts. So now we all know that the market doesn't trend forever, right? Eventually a bullish market is going to reverse, and eventually a bearish market is going to have some form of reversal as well. So we can usually anticipate a potential reversal when the market reaches some sort of overextension or has a shift in market structure. The next few slides, I'm going to illustrate this point. Now, market structure shifts, guys, is really good, especially if you want to develop into some sort of reversal trader, or let's say you look for a market structure shift on the lower time frame, even as the market is, let's say, retracing into a resistance level. Now, I'm going to cover that a lot later on, but that's just something to kind of keep in mind. Now, here we have some sort of premium level. Let's just assume that there's some sort of a resistance point, and this is how I personally approach market structure shifts. I only consider a market structure shift once price has hit a very key level. So a bearish market structure shift for me would be, let's say price hits some sort of a resistance, then we have a very strong impulsive move lower. Typically what will happen is once we get that market structure shift to the downside, now we can possibly look like, okay, maybe this was a short-term high in here, and the next level of retracement where we can get a Fibonacci extension, a Fibonacci, let's say a 62.70 in here. This could be a potential sell scenario and look to make a new low. And I'm going to show you guys an illustration of that here. This is a perfect example. Let's just assume that there was some sort of resistance level in here, maybe a supply level. Price comes up, price breaks the prior low before the new high. So this was kind of keeping our market structure intact. And once price has this really aggressive move lower, now we can look for potential sells if the market comes up in here. Now, sometimes, and I'm going to talk about this later in the section where it talks about lower time, like, confirmation entries, and when to use confirmations, when not to use confirmation, the pros and cons to using confirmations. But some people will automatically sell or retrace right back up into here once they draw their fibs. Some people will wait for, let's say, especially if it's like the first drop lower, some people wait for some sort of confirmation, which I typically like to do, and look for a sell scenario after they get some sort of confirmed entry. And again, we're going to talk about that in serious depth in the next couple of videos. You guys probably already see in the curriculum when we're going to talk about the confirmation entries and all of that good stuff. So obviously, inversely, it's going to be the same kind of thing with a bullish market structure shift. So when the market is bearish in here, we obviously see a clear bearish structural point. Now let's say the market has hit some sort of discount level, aka support. Now we can look for the market. If we break the last prior lower high, we can look for the market to potentially reverse. We have a market structure shift, and then the market, if we get some sort of retracement back into, let's say, the 60 to the 70, 79, we can look for a higher low to form, and then we look for a next higher high. So this is why it's kind of important to understand the concepts of a market structure shift, because we want to identify exactly when the market has potentially reversed. Now, is this always going to be the case? No, because sometimes the market is extremely bearish. You will have these types of move, and the market will just, this was like some sort of liquidity grab and drop lower. Now, there are ways to kind of avoid that, which we obviously will get into as we get more in depth within the academy. And again, guys, if you guys have any questions while you're going through the curriculum, make sure to write them down, because you guys can ask me these questions during our bi-weekly Zoom calls whenever we have the Q&A sessions. And that time is devoted 100% to you guys, so that way you guys can really get the understanding if you have a question. And here obviously is an example of this. So we have, let's say, the bearish structure in here. Then the market has a very strong impulsive move. We see the market kind of retrace a little bit lower, form a higher low, and we're off to the races. Now we're going to talk about minor impulsive legs. And the one thing that I want to talk about, right, the market has multiple legs, because some people will consider a impulsive move inside the market if the market has a big push. Sometimes there's a minor leg inside of that big push, and I'm going to show you guys an illustration soon. So the way I view the market legs, there are minor impulsive legs, and then there are full impulsive legs. Minor impulsive legs is the low/high that ultimately creates the push to a new structural high/low. Now, I call it MIL just for short. That can be used to aggressively look for an entry in a strong trending market. Now I'm going to obviously go ahead and show you guys a visual representation of this concept. Now, this is a perfect example, because let's say price has a low right here up to a high. Now, this right here is ultimately the higher low if you use a full impulsive leg. So if you use it from, let's say, this swing point here to there, this ultimately would be your higher low point. Now, when the market has a retracement like this, before making a new high, this right here is what I call my minor impulsive leg. This right here, from here to here, is the full leg. From here, because this was the last low before the new high, this is my minor impulsive leg. And again, it's just a good illustration from A to B. Then sometimes we can anticipate, instead of having, let's say, a full retracement down like from here to here, we would just have a retracement from the minor impulsive leg, and then we'll get, like, let's say, some type of 62, 70 entry retracement in here, and then look for a new higher high. Now, there's obviously specific criteria for this to occur. So instead of looking for a full impulsive leg retracement, but again, we're going to get into that a lot more in depth. Now, the full impulsive leg, as I was already stated, it would be the full swing from the swing low to high in a bullish example. That created a nice structural high. Full impulsive legs are typically good if you are looking for a deeper retracement in the marketplace. And we're going to show you guys that same example, but again, the full impulsive leg would just be from point A to point B. Now, in the next video, I'm going to show you guys good illustrations of this on the trading view chart to give you guys a visual representation with the actual candlesticks.